Let's see now dollar yen. Here the picture is also rather interesting. Support at $100 per 100 yen per dollar still in place, and it supported the pair for the third time. However, we don't see strong bullish momentum in this pair, and all in all, this resistance line since the beginning of 2016 is still in place, and the overall trend, if you look at the weekly chart, is still negative. Factors which support demand for Japanese yen are that the market's risk sentiment is rather negative. Firstly, we have these issues with European banks. Then there is the situation with oil market. Organization of Petroleum Exporters countries decided to cut oil production for the first time in 8 years. And although it is a big step, it means that oil exporters are able to reach an agreement and to make some changes in their policy. Still, there is a lot of skepticism that this oil deal will really help the prices to, if not to gain to higher levels, but to remain at current levels. I personally believe that the problem with oil oversupply in oil market won't be resolved this way, and that oil is now vulnerable to sell off, as traders will get more and more disappointed in what the Organization of Petroleum Exporting Countries had to offer the market. As a result, I think that this oil factor will add to the market's risk aversion, and the market's risk aversion will add to demand for Japanese yen, and it will be rather difficult for the pair to break higher. Also, traders know that dollar yen is very sensitive to the US labor market data. So until we have MFP figures on Friday, there won't probably be any big positions in this pair. And also, if we look at what is happening in Japan, there are some problems there. Inflation figures released in Japan came below forecast last week. Core consumer prices contracted by 0.5%. And normally such figures would make investors think that the Bank of Japan will intensify its monetary policy easing. However, there is speculation that the regulator has reached a limit in its stimulus program and is no longer able to make the yen decline. Last week, the Bank of Japan said that it would target 10-year bond yield at levels around 0%. But this week, the market pushed the yield to, last week, the market pushed the yield to levels below 0. And in order to stick to its target, the Bank of Japan would have to reduce its massive bond purchase program. Such step, of course, will be interpreted as a sign that the central bank won't ease policy further and the yen will strengthen. For now, the Bank of Japan tries to be flexible, tries to persuade the market that the bond yield target isn't strict, so there is no need to cut stimulus. But still, I think that the market is not convinced in the Bank of Japan's stimulus program, and this is why it will be very hard for the US dollar to break above this resistance line and show any significant gains against the yen. Today we saw the pair once again met resistance in the area of 101.70, 101.80. Bigger resistance lies just above 102, ahead of 102.80 and 103.80. And below 101, the picture will become bearish, and once again will target 100.30 and 100 mark. The next support lies around 99.30. So to make a conclusion here, dollar yen also will likely be used for some short-term bearish positions, but we expect no big moves ahead of the US non-farm payrolls data on Friday. If you look at the 4-hour chart, you can see that the range of the pair is getting more narrow, but there are resistance levels in form of moving averages on the upside, and we are now looking forward to 101 mark on the downside.